What is going on? Welcome back to Financial Times with Ted. First time going live, so wanted to kind of test this out. But this is the part two of the story that I made, or a little movie I made yesterday. Movie. I don't even know what I'm talking about. Video I made yesterday about getting your taxes back. So now you got your taxes back. Now what? So on the previous video, we talked about how there was two types of major purchases that people normally get. And TV's glare in the background. Let me shut that off for you real quick. But wanted to talk about the second thing that the majority of people do is they go on vacation. And before you do that, nothing wrong with vacation, but before you do that, let's pause for a second. And I know we talked about investing in dividends to make your car payment. I wanted to show you a spreadsheet that I broke down for you, and that way you can kind of make a decision. Um, going from there. And I know, people. You're always looking to better yourself. You probably talked about investing, probably talked about leaving your job, talked about maybe buying a new house, or just bettering yourself altogether, financially, mentally, whatever it may be. And this is a good way for you to finally start and take that tax return and really put it into something that's going to reinvest, not only reinvest in yourself, but reinvest in your future and build generational wealth. So I'm going to break it down and show you the spreadsheet real quick. So the average American last year received roughly, get this mouse out of your way. It was 32. I think it was around $3,200 in tax returns last year. But that was the average. So if you have more than one kid or more, and you're receiving $5,000 back, which I mean, the average return that I receive due to the real estate that I own is roughly anywhere between 6 to 8 thousand a year. So, but on my personal taxes, I always zero out. I never typically I owe the government maybe $100 here, maybe $1,000 there, but like not 9 times out of 10, I won't owe the government anything, or they'll owe me $100. But in terms of like my overall with my business and incorporates into my partnership, I typically get $6 to 8 thousand back a year, roughly. So let's break it down. And I've got this spreadsheet pulled up, and think about this. Take that $5,000 that you'll see right here. I'll highlight it for you. And you take that $5,000 and you invest it into these 4 dividend funds. I'm going to go ahead and post a link to a video that shows you how to set up a brokerage account. So you'll be able to look at that as well. But just going down the list, BCAT, AG&C, YMAX, and TSLY. 4 dividend funds, 4 different classifications. BCAT is BlackRock. AG&C is a mortgage-backed security backed by the federal government. Fannie Mae, Freddie Mac, they buy mortgage securities, underwrite mortgage securities. YMAX is the title trust group that underwrites option trade calls on dividend stocks. The YMAX is like their conglomerate stock. It's like a hodgepodge. It's like a big hedge fund. TSLY is another high yield fund based off of Tesla. They buy and sell options, calls, and puts on Tesla. So I broke it down for you. So you took that $5,000 and you divided it equally amongst all 4. And again, I'm not a financial advisor. This is just advice that I've pulled off the internet and over 20 years experience. So by all means, do your own research. But here's your stock price as of when I looked it up, which was earlier today, roughly February 27th. And this is how many shares it would get you. So 82 shares, 111 shares, 145 shares, 38 shares. Here are the dividends. And then you'll see over here in the far right-hand corner, pay frequency. So these 2 top ones pay monthly. These 2 bottom ones actually pay weekly. So the dividend, 26 cents on BCAT, 12 cents AG&C, and then 7 cents weekly on YMAX, 31 cents weekly on TSLY. And then you got your next column here, which breaks down your monthly income. So your projected monthly income, and again, dividends can change. They can go up and they can go down. So keep that in mind. So this number could fluctuate up, could fluctuate down a little bit. But BCAT and AG&C have stayed pretty consistent. YMAX and TSLY, because they're higher risk, tend to fluctuate a little bit more. So I just did the very last one, which are actually, because we're in such a downturn right now in some of these dividend funds. That's actually probably a 52-week low in terms of their payout. So I went on the low side for you. And then you break that, you get your yearly income. So that $5,000 potentially turns into $1,481.93 of annual income. And if you look over here on the right, you'll see that's a 29% return on your money in year one if you didn't reinvest any of it and just took it all out in cash. Now, keep in mind, you're going to have to pay taxes on this. This is not something that, like, oh, dividends, free money. Nope. You have to pay taxes. I typically set aside 15% of every dividend I make. So 15% of 1481, you're talking roughly $200 in that range, $240 maybe. So just set that aside into a high yield savings account, month over month, just to make sure that you'll be, free and clear, and you won't have to worry about paying taxes. But then if you look down here below, this is what it would look like if you didn't see any stock growth. So if the stock stayed still, didn't move up or down, which we all know that's not feasible, but this is just for, a measure to show you what the potential is. So if the stock didn't go up or down, the dividend didn't move, and if you reinvested every dollar of the dividend, which is this where it says after drip. So the after drip value, drip stands for dividend reinvestment program or dividend reinvestment participation. So that just means you're reinvesting the dividend every time it gets shelled out. So if you're reinvesting that dividend, and I did it on the annual basis. So if at the end of the year you had $1,450 in dividends, which is roughly what we have here. Though the numbers varied a little bit when you plug them into the calculators, but you get the gist. You're about $30, $31 off. So if you took that $1,450 and reinvested it, this is what the end of year two would look like. You'd have $2,237 in dividends. And then the end of year three, you'd have $3,219. And this is where it starts to get boosted up. This is the annual dividend, $4,442. You jumped up $1,200. And then all of a sudden, boom, that's a $1,500 jump on year five. Now, keep this in mind. You're not reinvesting any of your own money. You're just reinvesting the dividend. What if you took this number on year two and you got back another $5,000 in stocks, or not stocks, I'm sorry, in your tax refund? And what if you reinvested that into another four funds that paid an average of 29% annual yield, or even a 15% annual yield? And then what if you did that again on year three? What if you did that, or what if you did this? Let me go bring it back. What if you, instead of reinvesting at the end of the year, what if you reinvested monthly? What if you added $100 out of your paycheck every 2 weeks to your portfolio, and you just kept compounding that over and over, month after month after month? This number here of annual dividends of $5,967, you could potentially be looking at $10,000 to $12,000 of annual dividends just by adding your own money every month and compounding that interest. And remember what we talked about in one of my other videos? We talked about figuring out a way how to get your W-4 to pay the government the exact amount that you would owe in taxes. So if you're going to owe an exact amount of 22%, you want to make sure that every paycheck you're taking out 22%. It's not of your overall income. So it's not something where you're going to get a massive tax return next year. You're going to get that money back every 2 weeks, and you're going to be paying the government exactly what they're owed, and you're not going to have to sit there and fumble with getting a $5,000 tax return every year, which is not bad. But I would much rather see you get $400 a month in your pocket into your brokerage account, and that way that can continue, that continuation of compound interest in dividend funds grows and grows and grows. I mean, what if you did a 3-month cycle and you did these 4 dividends and you just reinvested your money into these 4 dividends for 3 months? Okay, there's 4 quarters in a year. And then what if you took another 4 dividends and reinvested the dividends in that into another 4 dividends? And then 3 months later, did another 4 dividends. And then 3 months later, did another 4 dividends. At the end of the year, you're going to have 16 paying dividend funds. So now all of a sudden you hear that, don't put all your eggs in one basket. Now you've got an expanded portfolio, 16 dividend funds in 1 year. So now you're making that $1,400 a year, all because you didn't take that $5,000 and go on that cruise. And I'm not saying don't go on a cruise, but hear me out. You ready for this? Let's go back to the money. At the end of that year, boom, you've made $1,400 in dividends. Let's say you didn't even touch the dividends and you didn't reinvest them. So at the end of the year, you've got $1,481. Hopefully, you still get your $5,000 sitting there. Stocks can go up and down, but let's say you took a loss of 20%. So 20% on $5,000 would be $1,000. So your core value would be down to $4,000, right? Now hear me out. Your core value goes down to $4,000, but what do you still have coming in every month? Your dividends, because you haven't sold any of the stocks. You still own the same amount of shares. So you got to focus on that. Now you've got the $1,400. Boom, then you go on a cruise. You come back from the cruise, guess what? If you use your tax return to go on a cruise, that $1,400 is gone. Bye-bye. You're never going to see it again. However, you come back from the cruise, you still got that dividend fund cycling money every month, spitting out dividends weekly, monthly, quarterly, whatever you're investing in. There's dividends that pay yearly, there's dividends that pay quarterly, dividends pay monthly, dividends that pay weekly, dividends that pay every twice a week. That's the crazy. There's a dividend out there that pays 8 times a month. So there's a world out there that you're missing that they don't want you to see. And that's what my channel is called Financial Times with Ted. Everything they don't want you to know, because these are things that if they taught you in the workplace or if they taught you in college or high school, everyone would retire by 35. Can you imagine if you started taking these funds at age 18 and compounded that interest for, we're talking about what, 10, 17 years? By the time you're 35, add three more years onto it. By the time you're 38 years old, 20 years of compounded interest into dividend funds, you'd be making well over $15,000 a month in dividends, and you probably wouldn't have to work. So these are the things that they don't. When I say they don't want you to know, this is not stuff that they're going to teach you. Now, every investment has its risk, so do your research. Like I said, not a financial advisor. I'm just giving you the information that I do personally, that I have succeeded with personally, and that I continually have a bankroll, shelling out money that keeps me comfortable, keeps myself and my family comfortable. I'm also a day trader. I also own real estate, but I wasn't able to do those things without budgeting, without investing in dividends. All of a sudden, boom, I'm getting a bankroll in dividends. Oh, I'm making $500 a month in dividends. That's covering my utility bill. That's covering my water bill, and that's covering my cell phone bill. Oh, sweet. So I got 3 bills that are covered in dividends. Now I can focus on other things, and it frees your mind up to go in other directions. So keep that in mind. I'll see if I can post this in the comments below once I can edit it. But take a look at it again. These are the 4 stocks that if I had $5,000 today, I'd probably dump into, or $5,000 today, and I was just starting out. This is what I would dump into. And if you want, I am going to figure out a subscription service, but I have a plethora of dividends on a spreadsheet, very nice and neatly organized, from real estate funds to low-cost index funds, to mutual funds, to retail funds, to high-yield funds, to mid-grade funds that all pay dividends. It's in the list of 150 to 250 dividends in that range. So I'm trying to figure out how to get that started so you can benefit from my list without having to dig it all around the internet and go from there. But hope this was helpful. Just goofing around with the live stream. Hopefully it works, and hopefully I don't have to do this again. But again, Financial Times with Ted. Hope you guys are having a great weekend, and back to it. Have a good one.